To understand why this moment matters, we need to rewind slightly. On January 29th, gold reached an all-time high of $5,594.82. It was the peak of a powerful rally driven by speculative momentum, geopolitical tension, and relentless buying pressure from Asia, particularly China. The narrative at that time felt one-directional. Central banks were accumulating, ETF inflows were strong, safe haven psychology was elevated. Silver rode that wave higher as well, benefiting from both monetary flows and its industrial demand story. But markets rarely reward consensus for long. When positioning becomes crowded, even strong trends become vulnerable. The shift began when Kevin Warsh was nominated as the next Federal Reserve Chair. His reputation for hawkish monetary policy immediately altered rate expectations. Investors recalibrated toward a higher for longer interest rate environment. That change had direct consequences. Gold does not yield income. Silver does not yield income. When rates stay elevated, the opportunity cost of holding metals increases. Capital seeks return elsewhere. The reaction was swift. Gold fell sharply from its peak, dropping toward $4,400 earlier this month. Silver, as it historically does, amplified the move. Its correction was even more violent. What had been enthusiasm turned into liquidation. Momentum reversed direction quickly. But corrections serve a purpose. They reset leverage. They flush excess speculation. They test conviction. And once that process stabilizes, markets often begin rebuilding structure. That is what we are now witnessing. Gold has regained the psychologically critical $5,000 level and currently trades near $5,034. Silver, after experiencing both sharp declines and sharp rebounds, has reclaimed and held above $80. The 6% daily surge earlier this week was not random volatility, especially considering the prior session saw silver drop more than 4%. That type of two-directional movement signals tension. It signals that the market is no longer trending blindly, but instead recalibrating. And this is precisely where the debate shifts from simple price observation to structural analysis, because a major industry analyst has now publicly stated that silver will outperform gold over the next few years, not potentially outperform, not possibly outperform, will outperform. That distinction matters. It reframes the conversation from whether precious metals rise to which metal rises more. It shifts allocation logic. It challenges traditional assumptions that gold should dominate in uncertain times. The reasoning behind this conviction is layered. The first layer is industrial demand. Silver is not simply a monetary hedge. It is a functional industrial component embedded in modern infrastructure. Solar panels require silver for conductivity. Electric vehicles rely on silver within circuitry and power systems. The rapid expansion of artificial intelligence infrastructure demands massive data center construction, which in turn requires extensive electrical components that incorporate silver. These demand channels are not speculative inflows driven by investor psychology. They are production necessities. When factories expand output, silver is required. When solar installations increase, silver consumption rises. When data centers scale, silver demand follows. This creates a crucial distinction between silver and gold. Gold's demand is primarily financial and monetary. It responds to real interest rates, currency concerns, geopolitical stress, and central bank diversification. Silver responds to those forces as well, but it also responds to industrial expansion. That dual identity provides silver with a structural base that is less sensitive to short-term investor mood swings. Investment demand can evaporate during corrections. Industrial demand persists because it is embedded in supply chains. The second structural layer supporting the outperformance thesis is the gold-silver ratio. Currently hovering near 63-1, this ratio measures how many ounces of silver equal the value of 1 ounce of gold. Earlier in the week, it was even higher, above 64. Historically, this ratio has fluctuated dramatically across cycles. During strong silver bull phases, it has compressed toward 40-1, sometimes even lower. A ratio near 63 suggests silver remains relatively undervalued compared to gold. If gold continues rising toward the $6,000 projections discussed by institutions, and the ratio compresses simultaneously, silver's percentage appreciation would need to significantly exceed gold's to close the gap. That is not speculative enthusiasm, it is arithmetic. Of course, ratios do not move on command. They can remain elevated longer than expected. They can expand further before compressing. But when elevated ratio levels intersect with strengthening industrial demand and renewed price momentum, probability begins to tilt. And then there is the institutional layer. Bank of America has outlined projections for silver between $135 and $390 by 2026. Even the lower bound represents substantial upside from above $80 today. Meanwhile, projections for gold suggest potential movement towards $6,000 if central bank accumulation persists. Comparing these targets side by side clarifies the asymmetry. A move from $5,034 to $6,000 in gold is meaningful. A move from $80 to $135 in silver is proportionally far more dramatic. If silver reaches the upper end of institutional projections, the relative outperformance becomes overwhelming. But projections alone are insufficient. They require context, and context includes risk. Monetary policy remains uncertain. Federal Reserve leadership expectations influence rate assumptions. Elevated real yields can suppress precious metals. ETF flows, particularly from Asia, remain momentum sensitive. If inflows continue, they support price. If they reverse, volatility intensifies. Geopolitical developments can shift safe haven demand unexpectedly. Industrial expansion could slow in a global downturn. Each of these variables interacts. As of Friday, 20th February, the market sits at a crossroads. Silver above $80 signals regained strength after correction. Gold at $5,034 signals stabilization rather than collapse. The ratio remains elevated. Institutional forecasts remain bold. Industrial demand trends remain intact. The next phase will be determined not by a single headline, but by how these structural forces evolve together. The silver versus gold debate is no longer theoretical. It is unfolding in real time, and understanding the framework behind it matters far more than reacting to daily price swings. If the first phase of this story was about correction and stabilization, the second phase is about probability. Because once volatility resets a market, the real question becomes not whether prices moved, but what direction they are most likely to move next, and why. Right now, the argument that silver could outperform gold is not built on excitement. It is built on structure, and that structure rests on three pillars: industrial acceleration, ratio imbalance, and institutional positioning. Let's start with institutional positioning because this is where expectations become explicit. Bank of America has projected silver trading between $135 and $390 by 2026. That is an unusually wide forecast range, but the important detail is not the upper extreme. It is the lower bound. Even 135 represents a massive expansion from current levels above $80. Meanwhile, projections for gold center around $6,000 per ounce if central bank accumulation continues at its current pace. From $5,034 FAR today, that implies roughly 20% upside. The asymmetry becomes obvious. Gold climbing to $6,000 is a solid advance. Silver climbing to even the conservative end of its projected range would represent dramatically larger percentage returns. The math itself forms part of the outperformance case. But forecasts do not exist in isolation. They reflect underlying drivers. For gold, the dominant driver remains central bank behavior. China has added to its gold reserves for 15 consecutive months. That is not momentum trading. It is strategic diversification. Central banks are not reacting to daily price changes. They are reallocating reserves in response to long-term geopolitical and currency dynamics. This creates a structural floor beneath gold that did not exist in the same magnitude during previous cycles. Even if speculative capital exits during corrections, sovereign accumulation provides underlying support. Silver, however, does not rely on central banks. It relies on industry. Solar panel manufacturing continues expanding globally as renewable energy commitments increase. Electric vehicle production, despite short-term fluctuations, remains a long-term structural growth trend. The rapid scaling of artificial intelligence infrastructure requires enormous data center capacity, and that capacity demands electrical components that use silver. These drivers create demand that is less sensitive to financial mood swings. Factories do not pause production because ETF flows fluctuate. Infrastructure projects do not halt because interest rate expectations shift marginally. Industrial demand, while cyclical, tends to operate on longer planning horizons. This is where silver's dual identity becomes critical. During periods of monetary easing or geopolitical stress, it behaves like gold. During periods of industrial expansion, it behaves like a growth-linked commodity. When both forces align, silver can accelerate sharply. That is precisely why its corrections are often more violent than gold's, and why its rallies can be disproportionately powerful. Now layer in the gold-silver ratio again. At roughly 63-1, the ratio remains elevated by historical standards. During prior strong silver cycles, it has compressed toward 40 or lower. If gold were to approach $6,000 while the ratio compressed to 40, silver would need to trade dramatically higher to balance the relationship. This does not require gold to underperform. It simply requires silver to outperform proportionally. Ratio compression is not guaranteed, but elevated levels create potential energy. When ratios sit at extremes, even modest mean reversion can produce significant relative movement. Of course, every thesis carries risk. The first major variable is Federal Reserve policy. The nomination of Kevin Wersch introduced expectations of continued hawkishness. If real interest rates remain elevated, meaning nominal yields stay high while inflation cools, precious metals may face friction. Gold and silver do not generate yield. Higher real returns elsewhere can limit upside enthusiasm. However, monetary cycles rarely remain static. Any shift toward easing, whether driven by slowing growth or financial instability, would likely support renewed upside in metals. The second variable is ETF flow behavior, particularly from Asian markets. The recent rally benefited from strong inflows. If that demand continues, momentum builds. If it reverses, downside volatility can accelerate quickly. ETF flows amplify price action in both directions. Monitoring sustained inflow or outflow trends becomes essential in evaluating durability. The third risk involves industrial slowdown. While renewable energy and AI infrastructure are structural growth themes, global economic contractions can delay projects or reduce capital expenditure. A recessionary environment could temporarily soften industrial silver consumption. Additionally, technological innovation allows manufacturers to reduce silver intensity per unit over time. Thrifting does not eliminate demand, but it can moderate growth rates. Sentiment is another layer. When projections of $300 or nearly $400 silver circulate widely, caution is warranted. Extreme optimism can coincide with short-term overheating. Markets often move further than expected, but they rarely move in straight lines. Managing exposure based on probability rather than certainty remains essential. From a technical standpoint, silver holding above $80 suggests resilience after correction. The next resistance near $90 becomes an important test. Beyond that, the previous high above $120 defines a longer-term target zone. On the downside, support near $75 remains critical. A decisive break below that level would reopen vulnerability toward the mid-60s. Gold consolidating near $5,034 reflects stabilization. Resistance remains near the January high of $5,594.82. Support near $4,400 defines the lower boundary of the recent correction. Both metals are currently compressing energy within defined ranges. Relative performance remains the core indicator. Silver's recent 6% surge compared to gold's 2.6% rebound suggests emerging strength, but sustained confirmation is necessary. If the ratio trends downward over weeks rather than days, the outperformance thesis strengthens. If it rises instead, gold reasserts dominance. Ultimately, this debate is not about choosing sides emotionally, it is about evaluating structural probability. Silver's industrial demand growth, elevated ratio levels, and institutional optimism create a coherent case. Gold's central bank accumulation, monetary sensitivity, and safe haven role create stability. The market now sits in a recalibration phase where these forces compete and interact. At this stage, the silver versus gold discussion is no longer about which metal is better. It is about how different forces inside the global economy are converging, and how capital is likely to respond. Precious metals are not isolated assets. They sit inside a web of monetary policy, industrial transformation, currency diversification, geopolitical uncertainty, and investor psychology. When multiple drivers begin aligning at the same time, cycles accelerate. When those drivers conflict, consolidation follows. Right now, the market is transitioning between those phases. Gold remains the anchor of the precious metals complex. Its behavior is tied closely to real interest rates, central bank accumulation, and global risk perception. China's consistent reserve additions over 15 consecutive months signal structural demand that is strategic rather than reactive. That creates stability beneath gold prices. Even during corrections, sovereign accumulation can cushion downside pressure. Gold trading around $5,034 after reaching $5,594.82 on January 29th reflects a market that corrected sharply but did not collapse. It is consolidating rather than breaking. Silver, however, operates with a different rhythm. Its volatility is higher because its identity is split. It is both a monetary asset and an industrial metal. When speculative flows intensify, silver moves aggressively. When industrial expansion accelerates, silver benefits from real-world demand. The recent surge above $80 following a 6% daily gain illustrates how quickly sentiment can pivot once selling pressure subsides. That type of move often signals that forced liquidation has ended and positioning is rebuilding. The gold-silver ratio remains central to this analysis. At approximately 63-1, silver continues to trade at a historically elevated discount relative to gold. During prior strong silver cycles, that ratio compressed significantly. Compression does not require gold weakness, it requires silver strength. If gold were to approach $6,000 while the ratio contracted toward 40, silver would need to rise sharply to balance the relationship. This mechanical dynamic is the backbone of the outperformance thesis. It is not emotional. It is arithmetic, but arithmetic interacts with macro conditions. Federal Reserve policy will remain influential. If real yields stay elevated for an extended period, metals may face headwinds. If growth slows and policy shifts toward accommodation, metals could re-accelerate. Monetary transitions often occur gradually, and markets typically anticipate them before official announcements. Each policy signal, therefore, becomes part of the broader equation. Industrial demand also evolves over time. Solar installations continue expanding globally. Electric vehicle production remains structurally important despite short-term fluctuations. Data center capacity linked to artificial intelligence infrastructure is scaling rapidly. These sectors embed silver consumption within long-term capital investment plans. While economic slowdowns can delay expansion, the structural trajectory remains upward. Silver's industrial role provides a demand base that complements monetary flows. ETF activity adds another layer of volatility. Inflows amplify rallies. Outflows accelerate corrections. Asian markets, in particular, have played a significant role in recent price movements. Sustained inflows would reinforce the bullish structure. Persistent outflows would challenge it. Monitoring those flows offers insight into short-term momentum without losing sight of long-term fundamentals. Technically, silver holding above $80 establishes a psychological pivot. If price acceptance remains above this level, momentum strengthens. Resistance near $90 becomes the next test, followed by previous highs above $120. Gold consolidating near $5,034 defines its own battlefield, with resistance near $5,594, $82, and support near $4,400. Both metals are coiling within ranges, compressing volatility before the next decisive move. The most important distinction now is time horizon. In the short term, volatility will dominate headlines. Sharp rallies and sharp pullbacks will test conviction. In the medium term, ratio movement and industrial demand data will provide clearer signals. In the long term, structural forces such as currency diversification, energy transition, and technological expansion will shape direction. The thesis that silver will outperform gold over the coming years is not based on a single forecast. It rests on the intersection of elevated ratio levels, expanding industrial demand, renewed institutional optimism, and recent relative strength. That does not eliminate risk. Monetary tightening, ETF reversals, economic slowdown, or excessive speculation could disrupt trajectory. But when multiple structural drivers align, probability shifts. As of Friday, 20th of February, with silver trading above $80 and gold at $5,034, the market appears to be rebuilding after correction rather than rolling over. The January peak and February decline reset positioning. The recent surge signals renewed interest. The ratio remains elevated. Institutional projections remain bold. Industrial expansion continues. None of these factors guarantee outcome, but together they create a framework that demands attention. Markets reward preparation more than prediction. Understanding why silver might outperform gold rather than simply reacting to price changes allows for strategic positioning. Whether silver ultimately reaches $135, $150, or higher will depend on how these forces evolve. Whether gold approaches $6,000 will depend on central bank accumulation and monetary shifts. Both paths remain plausible within the current macro environment. The silver versus gold debate is not a competition rooted in loyalty. It is a question of relative momentum inside a transforming global economy. Precious metals cycles unfold gradually, shaped by policy decisions, industrial growth, capital flows, and investor psychology. The next chapter will not be defined by one dramatic session, but by sustained confirmation of structural strength. Everything discussed here is derived from publicly available market data and analysis. This is educational content and not financial advice. Investment decisions should be made independently, based on individual research, personal risk tolerance, and consultation with qualified professionals where appropriate.